Okay, so today is 27th April 2026. Let's have a macro view on the market. So right now the market is sending us mixed signals. On one side, US equities are near high. On the other, global risks are quietly building. If you are looking only at the price, you are missing the real story. This is the current macro view coming out of the institutions like JP Morgan, and it's not bullish, it's cautious. So let's talk about the core idea of the market today. We are in what they call a bifurcated market. US markets are strong, driven by the AI capex and earnings. But at the same time, geopolitical risks, especially around the Strait of Hormuz, is pushing energy prices higher. And that's the problem. Because rising energy costs leads to pressure on global growth, especially Europe. But what you are seeing is strong headlines but fragile structure underneath, and the catalysts are: the first one is oil stability, not panic anymore but unstable pricing. The second one is earnings, AI stocks must deliver or the market will de-risk very fast. The third one is Fed policy, not when the rate cuts but how high they stay. And here is the key insight: the market is still too relaxed for these risks. Let's come to the market reality. What's going under the surface? The market breadth is weak. Only a very few key stocks are carrying everything. Second one is credit stress is rising. Third is the hedge funds are reducing risk. And in the last, liquidity is thinning. And this is not a strong market at all. This is a concentrated one. So how is the positioning going in the market? Let's talk about that. The institutions are not chasing upside blindly at all. They are hedging long, overweighting commodities, holding cash and preparing for volatility. So the real question is not is the market going up? The real question is how fragile is the move and who is gonna caught when the liquidity disappears. Because in this market, price can lie but the positioning doesn't. So my point of view is this is a late stage liquidity environment. Till eyes are seeing bullish continuation, but the institutions are already shifting to defense. The biggest mispricing right now is complacency towards energy driven inflation. If oil sustains or spikes, it directly hits margin, growth, and ultimately equity multiplies. Also, the AI driven market strength is dangerously narrow. When the whole market leadership compresses in a very few frames, it increases systematic fragility, not strength. If even one major earning disappointment hits, systematic sellings like CTAs, quant funds can accelerate downside quickly. In short, this is not a trending market, it's a trap down market. Keep in mind that. That's all for today. Thank you.